Tax reduction strategies for high-income earners is the topic on this week's Your Money, Your Wealth TV show. Watch it and download our free 2018 tax planning checklist at yourmoneyyourwealth.com. And be sure to subscribe. New TV episodes are available every Sunday. Now, today on the Your Money, Your Wealth podcast, is the 3-bucket investing strategy good for large portfolios? Plus, what is net worth and what's the real value of your net worth? And you'll think the fellas have lost their sanity when you hear them talking about ways to protect your sanity and your money as you age. And on the heels of the Red Sox winning the World Series, Big Al's got some baseball and money stats. But first, over the past week, the market has been in correction territory more than once. Here to calm our nerves are Joe Anderson, CFP, and Big Al Clopine, CPA.
Now we hit almost correction zone.
We did. Yeah, we've had kind of a rough week and a half.
A rough month. Almost down 10% across the board with all indices.
Right.
What do you think is the reasons? There's a lot of pundits out there saying a lot of different things.
Yeah. Well, I'll tell you what my answer to that is. There's not much rhyme or reason. People try to assign reasons.
I know, it's crazy,
but it doesn't really work that way. I mean, there is a lot of emotion, and sometimes when stocks go down, people get fearful, and then it exasperates it. The same happens on the upside too, but it doesn't seem to be quite as dramatic on the upside as it is on the downside.
So first, let's define what a correction is. Correction is when a stock market is down 10% of any recent high. The frequency on it happens a lot more often than you think.
Correct.
You know, on average, it's 1.5 probably times a year.
Yeah.
You know, even though we don't experience maybe it, 2 times a year. But there's been some years where you're going to see a lot more volatility than others.
Right.
And I think we've been complacent, and recency bias is really, in the forefront right now because I think a lot of people are freaking out a little bit.
Well, because the stock market historically is volatile. And just like you said, typically each year we'll get one or more corrections. And the fact that we've had so few the last 9 years it's like people have forgot this is normal. That's normal to have corrections.
Right. And if you're a saver right now, you should be extremely excited.
I totally agree. So explain.
Because when markets go down, and if you're saving money into your 401k, IRAs, Roth IRAs, brokerage accounts, you know what? You're buying these same really good companies, really good stocks, really good mutual funds at now a lot lower price.
Right. If you're adding new money, you're getting cheap prices.
And so if you are an investor at all, if let's say, I know some of you are listening and saying, Joe, I'm 65 years old, I'm looking at retiring in the next couple of years and I need this money. Well, yeah, but you need that money to still continue to last you another 25 years potentially.
Right.
65, 75, 85, we run all of our financial plans to age 90.
95.
95.
Correct.
Thank you. And so...
We should probably change it to 100.
Yeah, I saw Rick Edelman's plan. It's like it's a big plan because it's about 250.
Right.
But if you look at it that way, you have to have some sort of equity in the overall portfolio. And when markets go down 9, 10%, what you should be doing? Instead of freaking out and going to cash, you should be buying more and rebalancing the overall account. That's what buying more means. Now, if I'm saving, let's say 5 years from retirement, 10 years from retirement, 30 years from retirement, you want to see a correction. You want to see this thing to continue to fall. Right? Because all of this is really kind of on a lot of noise, to be honest with you. Right? What we hear so there's trade wars, tariffs. Then you got this whole crazy thing with Saudi Arabia. I mean, what the hell's going on with that whole thing? And then, right? And it's like, okay, well, what is that going to do to oil? And then you have, Italy is doing their own thing with the Eurozone. They're like, hey, we like to spend money, go pound sand. And then that's kind of causing friction.
Sure.
And so, right, the market totally overreacts quite a bit. And then you look, we got midterm elections coming up, right? So, I mean, it's weird how these politicians kind of pull stunts, try to, all of a sudden it freaks people out and saying, well, I want to go either right or the left because of what I'm feeling right now. I'm probably going to get a couple of emails for that comment, but that's all right.
You notice how I'm being silent.
Yes.
You just keep on talking.
Sure, but here's what, if you look at all of the different things that are going on, right? There's always going to be crises. There's always going to be issues. There's always going to be things that are not good, and the media likes to play on that.
Yeah, and I think that's what we forget. And you can go back 6 months, a year, 5 years, 10 years, 20 years, 30 years. There's always crises happening.
Right.
And we forget that. It's like, it just seems like it's never been like this.
Sure.
It's like it's always been like this. What are you talking about?
Right. But when you hear all of this stuff, but when the market goes up, it's not really, it's not that big of a deal. But when you see market volatility, and then people really start to focus in on it.
Right.
Right. It's like, the problem is that when individuals retire, and if they don't have a really good strategy for their retirement, and not necessarily the financial part of it, but how we like to talk about the softer side. I mean, they need hobbies. People need hobbies, because when they're retired and they're living off their money, what do? They look at it more often than they probably should.
Yeah, I agree.
And
with
if
that.
I'm continuing to look at my assets, then I'm looking at the news, and then all this crazy AI BS is unbelievable, because you look at one stupid thing on your phone, right, on whatever feed that you're doing, the next thing you know, you're bombarded by it. What the hell's an inverted yield curve? I heard that. And then you type that stuff up on your phone, and then you get 45 articles on how the world's going to end, and there's a recession because of an inverted yield curve.
And there's all these experts, and you think I'm not an expert. They are. So I guess I should
Right. Oh,
sell.
I mean, if they have an article on Facebook, they must be a true.
That is true.
Right. So anyway,
well, I guess so. The takeaway is that when markets they decline, so correction. So we're in or near a correction right now. That's defined as 10% from the highs, and that's normal. This is usually, on average, as you say, Joe, happens 1 to 2 times per year. We haven't had too many lately.
Right.
So this is kind of more the norm.
But I think there's a lot of really good news too. I mean, earnings report are coming out. Within the S&P 500, there's more companies that have very good.
They're beating expectations, aren't they?
Killing expectations.
Yeah, and then you look at
like Tesla, for instance.
you look
They're
at-
like, what the hell? Elon Musk was going bananas a couple of months ago, because why? Now the reports come out, the guy killed it in the third quarter.
He did kill it, and then we've got almost all-time low unemployment, right? So we got people working. We've got lower corporate taxes, so there's more profits for companies. And yeah, some of that goes back to the shareholders, but some of that's reinvested in buying new machinery, hiring more people, so more people are working. There's actually, you're right, there's a ton of good news.
Right.
And in fact, it's to me, if you wanted to just write an article about good news, you could write it and everything would be 100% true, and you go, oh my gosh, this is the best time in the history of the United States to invest.
Sure.
And then you could also pluck out all the bad stuff.
Right.
And
say this is the worst time to
always
invest.
been that way. Always. That's the takeaway.
So, I want this market to continue to kind of shake things up a little bit. It wakes people up.
It does.
It gets them a little bit more in tune. I don't want you to freak out. I don't want you to do something stupid, but I think a lot of individuals need to relook at their overall portfolios. They need to reassess their goals. What are they trying to accomplish? And then get tight, get fine-tuned on your strategy, and making sure that you know how much risk that you're taking on and what type of risks are out there.
Yeah, I think true, because I think a lot of folks, like their 401k, for example, maybe they got some kind of allocation from somebody 10, 15, 20 years ago, and they haven't really looked at it since, and they don't even know if this is the right thing for them. And this is sort of a wake-up call. You got to figure this stuff out. You got to figure out what portfolio is going to make sense for you and your goals, and make some adjustments now.
Right. If you got a 10, 15, 20-year time frame, I mean, you want this thing to go down another 10%. Right?
Yeah.
It's like it's normal. It's refreshing in a sense. I mean, if the thing just kept going up, this has been the weirdest bull market. I've been in this business 20 years. So I lived, I feel old.
20 years.
Man, jeez. But I remember 2000 through 2002, right, the dot-com bust. And then it was like, oh my gosh. And then you see the recovery on that. And then that was, all right, so now the stocks are good. And then you get wiped out again from the Great Recession.
Sure.
But it was like, it was like too soon. You know what I mean? It was like I just lost half my money only like 5 years ago, and then I lose it again.
Lose the other half.
And so there was so much negativity within the overall stock market.
Yeah.
And it took people forever to actually trust the system, right? And so they missed out on a huge gain. So this whole bull market that we've experienced over the past 10 years, what, up 300 some odd percent?
Right.
Is that it's been kind of like, oh, well, is it really is it good? Is it bad? And then now it's too froth. Should we get out? It's never been like, let's grab the bull by the horns, no pun intended, and let's ride this thing.
Yeah.
So I think a correction is healthy. I think, a little bit of a bear market every now and again is healthy, because then guess what? Your expected rate of return is going to be a lot higher.
Yeah, because stock prices are lower. And that's what people don't understand. When stock prices are lower, your future expected return is higher. So, and let's define a bear market. Bear market is when it's at 20% down from highs. So correction is 10%, bear market's 20%. Somewhat arbitrary. Whoever came up with that, I don't know. But that's now what we call corrections and bear markets.
Sure. But some people got to be prepared. If you lose 20% of your money, what is that going to do to your retirement? Do you have a plan to take dollars out of your overall portfolio that's not going to affect your stock portfolio?
Sure.
Do you have enough fixed income in place? Do you have enough, do you have a bailout plan?
Yeah, do you have enough
a plan
safe
B?
assets that you can pull from while you wait for the stock market to recover?
For investing strategies to help you ride out the market declines, visit the show notes for today's episode and watch our video, Preparing for a Bear Market, a Comprehensive Guide. Pure Financial's Director of Research, Brian Perry, CFP, CFA, explains the signs and indicators associated with market declines, like the ones we've been experiencing lately, becoming a bear market, the history of bear markets and their recoveries, and most importantly, bear market investing strategies. Find a link to the video, Preparing for a Bear Market, a Comprehensive Guide, in the show notes for today's episode at yourmoneyyourwealth.com. Now it's time to open up the email bag. Send your comments, suggestions, and money questions to info@purefinancial.com, just like Chuck from Virginia did.
Wow, we got people from all over the place.
Yeah, we do. That's cool.
Hey, I have just discovered your web reports. I don't know what web reports are, Chuck, but I guess we have them, Al.
Yeah.
Joe and Big Al are great. They speak to my level of expertise. We have a financial advisor we are happy with, but I will check into you regularly.
Oh, well, thanks, Chuck. Good
That was
comment.
very nice, Chuck.
Actually, I guess in full transparency, we do have clients. We're looking for clients, but the truth is we do this for you guys. And it's like we always say that everyone needs a financial plan. Not everyone needs a financial advisor. And if you need a financial advisor, not everybody needs to use us. But if you're getting good information from our content, we're happy.
All right, we got Rich from Chi-Town. Hey, guys. Thanks for the great show and entertainment. Well, thank you, Rich. I am a few years from retiring and have a question about the 3-bucket withdrawal strategy. If I understand it correctly, the first bucket is short-term money, cash, 1 to 2 years. Second bucket is mid-term money, bonds, 3 to 9 years of expenses. And the last bucket for the longer term, stocks. They say this is good since the 3 to 9 year bond bucket would carry you through a recession without you having to touch the third bucket of stocks. If correct, my question is, how would this work if you had a large portfolio? If you had $3 million and needed, say, $50K a year, doing the above would put you in an allocation of about 85% stocks and 15% bonds. Isn't it too risky? Does the bucket approach make sense for higher portfolios? Thanks.
Great question.
Buckets.
Yeah.
What say you there, Big Al? What's your answer of this question?
Well, let me see if I
Rich?
can sort of paraphrase the buckets of money strategy. So I guess the idea is you have really safe assets in the short-term bucket because that's what you're going to draw upon for the next year or two, maybe 3, whatever.
Annuities and non-traded REITs.
Absolutely not, but that did happen. And then the second bucket is kind of like
annuities and non-traded
mid-range.
REITs.
Yeah, that's exactly what was in the second bucket, and that there were some issues there. Anyway, that's a whole other show topic. And then the long-term bucket is your stocks, your long-term money. And
variable annuities.
Yeah, there was a few stocks in there, I think. Anyway, the concept is fine. I guess we would say it differently, though. Yeah, so although I like the concept, I'm going to tell you how we would think about this, which is kind of get rid of the buckets of money idea. Although it's not necessarily bad per se, but I would say this first. There's a couple ways you can go about this. One is, Rich, to figure out what your spending needs are, and it sounds like you already have. That's $50,000 a year. Okay, so let's make sure you got at least 10 years of safety, so that's 50 times 10, that's 600,000. That's probably where you came up with the 15%, I'm guessing, of the $3 million. That is a way, but that's only one way to figure out exactly what you want. That's one approach. Another approach, go at a different direction, which is the $50,000 out of your portfolio, $3 million. What rate of return do you need? Right, and the rate of return is probably relatively low at 50,000 on 3 million. That's probably, what's that? That's 1.5%, maybe,
Yeah.
Something like that, lower than 2%. So in other words, you don't have to take much risk. You could have a much higher bond portfolio if you want to. On the other hand, because you have not that huge of a need, you could take bigger risks. So now I'm going to go back to what's your long-term goal? Do you want to grow this thing for your kids, for charity, or are you good with where you're at? You just want to be safe. You don't really want to be bothered with the ups and downs of the market. You've got a little bit of latitude there.
Right. I got a few comments.
Okay.
Yeah, given the bucket strategy, there's multiple bucket strategies. There's just an individual here, used to practice in San Diego, that had a book that was called that. So, but no, I like this strategy a lot, actually, in regards to looking at having different components, if you will, to say, hey, over the next 10 years, just be very safe, because there's very rarely have you seen a 10-year period where a globally diversified portfolio has lost money. Yeah,
so make sure you got 10 years of income needs and really safe money that you can withdraw.
Right.
Regardless of what the market does.
But then I'm looking at Rich's point. He's like, well, wait a minute, man. I don't need a ton of money.
Right.
And if I got several $1 million, does this even make sense? So how you have to look at it is a few different things. That's kind of the first step. It's like, all right, well, here, you need $600,000.
That's where you start. It's not where you stop.
Yeah,
that's
right.
where you start.
That's where you start, and then you're like, well, wait a minute, this is a lot of risk here.
Yeah, because you're telling me the rest in stocks. That seems like a lot.
Right. So there's something that's called risk tolerance and risk capacity. We've talked about this a little bit in the past. And it's like a lot of times it's the opposite, where people have to take on maybe a little bit more risk than what they're comfortable with. Because
they need too high of a rate of return.
Yes, they need to generate a 4, 5, 6% rate of return versus maybe just sitting in cash or T-bills.
Right.
And so there you have to push that individual to say, hey, you might need to take on a little bit more risk to outpace taxes and inflation and accomplish your goals. On the flip side, Rich here, he could sit in cash and accomplish his goals.
Right.
Right. But is that the prudent thing to do? So I agree with you 1,000%, Al. It's like, all right, well, here, I think you're fine. What you could do, Rich, is say, all right, let's carve this stuff out so I know that I'm going to be safe for the next 40 years. He's only 56. Right. So then no matter what happens within the markets, within the bond market, stock market, you and your family are going to be fine. You throw a different what if in there, a long-term care stay, all sorts of crazy expenses. And then after that, you could say, well, I still have these dollars here. Maybe you want to take on risk for that, for your kids, your grandkids, for charities or things of that nature. So it really depends on his goals and what he's trying to do. But here's what I would say. I would take the least amount of risk possible to accomplish your goals.
Yeah, I think that's the key, right? So make sure you got 10 years of safety and then take the least amount of risk to accomplish your goals on the rest of it.
Right. And those goals could be several goals. It could be, all right, I want to make sure that I have a little bit for my kids. I want to make sure I have a little bit for some charities, for my church, and blah, blah, blah.
Yeah, long-term care. And a lot of folks, when they actually do retire, they end up spending more. They travel more, right? They spend more on hobbies. And it's like you're around the house more. And it's like, oh, gosh, it'd be nice if I had a patio. So then you go out and buy the lumber, or you hire someone to do it, and all of a sudden you're spending more money.
So I would encourage Rich to spend more money, but if you're 56 and you got $3 million, he's a pretty good saver,
right?
Unless he inherited it all, which could be a possibility.
Or he
as well.
worked for a company that had stock options, or
he just
business
got
owner,
really lucky,
or real estate.
He probably hadn't saved a dime in his life, and
lottery winner.
Yeah.
It is.
So that's our 2 cents, Rich. Appreciate you tuning in to us and writing in.
If you're the visual type, video of Joe and Big Al answering some of your emails, like that one about the bucket investing and withdrawal strategy, are now available on our YouTube channel. You can also watch the Your Money, Your Wealth TV show, see hundreds of videos on just about every personal finance topic that affects you, and even listen to the entire podcast on YouTube if you so desire. Find links in the show notes at yourmoneyyourwealth.com or check us out and subscribe at youtube.com/purefinancialcfp. Time now for Big Al's List. Every week, Big Al Clopine scours the media to find the best tips, do's and don'ts, mistakes, myths, and advice to improve your overall financial picture in handy bullet point format. This week, 11 ways to protect your money and your sanity as you age.
This is written by Ken Fisher.
All right, so this is timely because the markets are volatile.
Correct.
So you got to keep your emotions in check.
Yes, you do.
And you got to be smart with your money. And that's not saying don't do anything. That's being strategic on what you should be doing right now in volatile times.
Yeah, so I'm going to go through these and let's see if we agree or disagree.
Got it.
Okay, here's the first one. Take seriously the need to finance a long life. You'll likely live lots longer than you expect. Lifespans keep increasing and will continue to increase. In 1952, the average expectancy was 68.6 years. By 2006, it was 77.8. But here's the more important stat, although it's not in here, is if you made it to retirement age, and let's just call that 65. If you made it to 65, in all likelihood, as a male, you're going to live 20 years. As a female, 24 years. Right? That's really what you have to fund in retirement. That's the median. That means half of you are going to live longer than that. So you probably ought to be set or planned at least age 90, maybe even 95.
Sure. Yeah, I agree with that wholeheartedly. I mean, there's so much advance in technology. It's crazy. Just think in the next 5-10 years what's going to happen.
What's already happened and what's probably going to happen.
Right. So, yeah, longevity is here, and I think people are a little bit naive with it.
Right.
Because they might not have saved enough, and they'll be like, oh, no, I'm not going to make it that long, or,
right.
I don't want to plan. Well, sure. We never know when we're going to die, and I don't think we want to know. I surely don't.
Yeah, I don't either.
But you absolutely have to plan, because if you think about it, just picture yourself 15 years from now flat broke.
Right.
Right?
Yeah, so you made it to 80, but you got no money.
Yeah, then you're done. It's like,
right.
Well, no. I mean,
not a good way to go out.
I mean, Al, you're 60. It doesn't probably feel like you're 60, does it?
No.
You probably feel like you're 40.
Exactly.
Exactly.
I feel younger than you sometimes.
Yeah, you'd look it too.
Not really. All right, here's number 2. Be clear early about family support limits. Let me explain.
Ooh.
Before it arises, decide with your spouse the limits on what you will and won't do to support family members. Too much or too little causes bad outcomes. If the topic of support comes up and you didn't plan it in advance, you will likely be too emotional and likely to over or under give, and your relationships may suffer.
Put that in real terms. It's like, all right, well, Junior needs a little bit of cash, and so we're going to put a limit on what we give?
Yeah, so Junior lost his job, for example, and it's like, all right, well, we have to pay his mortgage for the next month or two,
and
which becomes a year or 2 years.
So then you say, okay, we cut this thing off before Junior even loses his job, and say, if this ever happens, then we're only going to give a certain amount of money?
Or I think another way to look at this is if your kids think of you as a piggy bank, it could stifle their motivation to be successful, and then they could come back to you.
Oh, okay. Are you speaking from experience?
Slightly. I know you don't have kids, so you don't really get it.
No.
But does that go the other way as well? If you're a part of the sandwich generation, what about taking care of your parents?
I think so, right? And then certainly if you run out of money at age 80, you're going to be asking your kids for support. Maybe they need to have the discussion earlier. Okay, not much more to say about that one. Number 3 is consider downsizing. Saves money, makes life more manageable, eases future burdens on offspring, but it causes more upfront hassle and reduces the guest potential. In other words, if you have less bedrooms, less guests. Maybe that's a good thing.
That's probably a really good thing.
You've got too big of a home. Have you ever had a night in the last 2 years where you didn't have a house guest?
Yeah.
Yeah, because it seems like you always have at least one or two.
Someone always kind of crashes over. Yeah, the past probably 2 weeks have been very nice.
Just you?
Yeah.
I know we had a little gathering at your place.
Yes,
last
on Friday.
Yeah, very very fun, by the way.
Yeah, it was a really good time.
Yeah.
Yeah, so yeah, I had a couple of people crash Friday.
Yeah, so you
but
had
then-
one
so-
night.
But then, yeah, and then my sister was in town
what
on
I'm
Saturday, and then she stayed Sunday, Monday, Tuesday, and then Wednesday, Thursday, tonight.
Tonight's free.
Tonight's free.
What about this weekend?
Yeah, all good.
Anyway, so downsizing, and what's interesting is a lot of people don't want to downsize. We've looked at all kinds of stats, and very few people actually want
Right,
to.
they want to live in their home.
Because they're used to it. They're used to the neighborhood. They've got their friends there. They've got their life there. Maybe their stores are there. Their churches are there. Whatever. Their social functions. All the above.
I mean, you get a sense of comfortability too.
Yeah,
you know,
yeah.
You're familiar.
Right.
You might you have friends with your neighbors and things like that. And,
Right.
You know, the general store is just
Yeah.
right down the street. And you know, so
Yeah.
I could see that.
Yeah, but at the risk of being obvious, sometimes the bigger home is harder to take care of when you're older, right? And if you downsize, by definition, that means you're buying something cheaper, so you'll end up with more money in your pocket and hopefully more to spend and retire with. The fourth thing is consider upsizing. So this is the opposite, right? Big gatherings, room for lots of grandchildren. Nothing beats the grandkids, Joe. That's what Ken Fisher says. Get your kids to have more, which is the best tip of all. Have more grandkids.
Yeah, when you're worth billions, you can buy them. I guess.
He's doing pretty well, right?
Yeah,
He's probably
he's not hurting.
He probably upsized.
He probably
when you
did.
think.
And
Yeah.
he's got the cash.
So that's the problem with downsizing, right? So you go from a 4-bedroom home to a 2-bedroom condo, and then all of a sudden the whole family wants to come over for Christmas.
Yeah, I
Kinda
could see
hard
that.
Hard to do that.
You know, especially if they, had that big tradition to do that and cater to the family, and that's something really special. But
Right.
I mean, people will go deep in debt, flat broke for that type of stuff.
Yeah. Yeah, it's true. Yeah, it's emotions, right?
Yeah.
Fifth one is consider moving closer to your grandkids. And then he has a one-word sentence. Fun.
Apparently, he's got a couple grandkids now, and he just got all emotional and started writing a blog.
And then he writes, and maybe you can coerce your no-good kids to do more for you. Wonder if is that from experience?
Oh, jeez.
And if your kids are good, you want to help them. You will want them helping you as you age. If I could read this, that'd be really good.
Is that 11?
Feels like it.
Yes.
Next one is if you can involve offspring in your financial decisions. Have your kids involved. That's a mixed bag, though.
Yeah, totally.
Some parents are okay sharing that. Many, I would say, are not, especially if they have a lot of money and they don't necessarily want their kids to know it.
Yeah, for sure. On the other side, too, if you're flat broke, you don't want your kids to know it, too.
That's true.
Right? Because there's a lot of facades out there.
Right.
Where, I mean, I look back at my parents, and when my old man died, I mean, he didn't really, there wasn't a lot there. And then now as you get older,
Right.
it's like, okay, well, he died at 60. And it's like, well, he should have accumulated a couple of bucks.
Sure, right. Yeah.
Right?
Especially with a financial planner son.
Sure.
Didn't you, wasn't he your first client?
Yeah, he gave me like, I don't know, 20 grand. Just blew it. but Putnam new opportunities.
That would have been
high-tech.
his future.
Yeah, exactly. It was like a high-tech fund. I bought it right in 1999.
Right.
And then, imploded. So, but they did everything they could. I didn't know my parents were struggling.
Right.
Because
and you wouldn't as a kid.
Right.
Except you probably knew you didn't go out. You didn't have lavish trips, or you didn't really probably go out to dinner much, or maybe you did. I don't know.
No, not really. But
Yeah.
I mean, I guess I wasn't hurting for it. I didn't really know any better.
Yeah. Same with me.
But I wore nice clothes. It wasn't like we're going.
Your mom didn't make them.
No,
My mom made some of mine.
No.
Yeah, the brand of choice at the time was OP, Ocean Pacific.
Oh, yes.
And the two little bare feet on it.
I know.
And my mom, she would make.
So she counterfeited.
She did, because she would buy the same cloth they did, make the same shirt, and then she would sew this little feet on it. It's like, Mom, I don't really care. I'm not really I'm not very cool, so no one would notice. I don't even know the difference. She said, well, don't you want the brand names? I remember wearing the jeans, and she said, don't you want the Levi's? I said, Sears brand is fine, Mom. Well, come on, you're high school now. The kids are going to make fun of you. Oh, they already do. So I wore tough skin Sears jeans.
Yeah,
still wearing them.
I would say I was the opposite of that.
Yeah, I could see that.
High school, when all I cared about was music and boys, and I played drums in marching band and got a mullet haircut just like the lead singer of Def Leppard, and no, that did not get me any dates. Anyway, if you're in Southern California or will be visiting, you're invited to our office in San Diego for a free lunch and learn on Thursday, November 29th at 11 a.m. Pure Financial Advisors Director of Research, Brian Perry, will go over the state of the markets, what's predicted for 2019, end-of-the-year tax strategies, ways to reduce your taxes in retirement, and more. Visit the show notes for today's episode at yourmoneyyourwealth.com for the link to sign up. The lunch and learn is free, lunch is included, awkward high school photos are not. And now, more hilarity ensues.
This is 11 Ways to Protect Your Money and Sanity as You Age, written by Ken Fisher.
So he's probably feeling what? He's aging?
Well, yeah, I'm sure you've heard him speak. And
He's very,
he talks in short sentences, and he writes in short sentences. Because the seventh one is, drive the safest car you can. When I was young, I hot-rodded. Is that a word?
Yeah, you hot-rodded.
I know, but is that how you say it? I would say I drove a hot rod. Not that I hot-rodded. I don't even know what that means.
Because you wore Tough-Skins jeans.
Yeah, tough skin. Not tough kids. Tough skin. The Sears brand Tough Skin. The reason why they were so good is you wouldn't wear.
You weren't hot-rodded. I'll tell you that. You're not on the strip with the ladies.
I wasn't in a hot rod. The reason why I wore those jeans and liked them is they were double stitched in the knees, so you wouldn't wear out your knees. Now, of course, it's
Why were you on your knees?
Because you're playing sports. You're sliding into bases. I don't know, whatever else.
Jeans?
Yeah, that's all I had. I didn't have a uniform like you did. I played in my counterfeit OP shirt, my tough skin jeans. That was so good. I would get to second base. I couldn't run any further. I was too tired. The jeans were too tough. I could not catch a fly ball in the outfield. Not too far. That's a homer for sure. So,
oh my goodness gracious!
So if you trying to get back to the point, drive a safe car. What would you drive if you wanted a safe car, Joe?
Oh man, I don't know.
Guess what Ken has?
Like a Mercedes.
No, you're right.
G-Wagon?
He has a Volvo.
Yeah. Okay.
He said he's come to appreciate and love Volvos.
Okay.
Because they're safe.
Yeah. They are safe. Very safe.
So anyway.
Yeah, that's what Suze has to drive.
I know.
She's the only person in the world that says I'm a really bad driver.
Yeah. Everyone else is above average, except for her.
Yes.
She knows it.
She's like, yeah.
So I've heard about. I've never actually ridden with her. You have, right?
Oh yeah.
So what's the experience?
Like gas pedal, and then
Brakes.
gas pedal brakes. It's like Whiplash City.
Well, that's good that she has a Volvo.
Yes.
She's got a big one too.
Yes.
So
yes.
she's probably pretty safe.
Yeah, little dings everywhere on the thing. I parked next to her.
So number 8 is build a cushion into your financial plan. Not everyone is highly disciplined about spending and planning. If you suffer a big gap between plans and realities, it causes anxiety. So how do you create a cushion?
What is that, a cash reserve?
I guess.
Yeah, that's tough to do, I guess.
Yeah, it means you have to save. I mean, we all want a cushion.
Sure.
Doesn't say how to do it. Ken, come on. Tell us what to do.
Give me a little meat here.
I guess what he's getting at is probably for those of you that are not yet retired, but thinking about it, try to save more, save more to create a little bit extra. You know, if you think you need a couple $100,000, maybe shoot for $300,000 or whatever the number is so you got a little extra. I'll go with that.
Sure.
Yeah. Okay. Number 9, know your net worth, but don't obsess over it.
Well, your net worth is
What is net worth?
It's oh, God. Your net worth.
Just trying to weave you into the conversation.
Thank you. Oh, God. It's all of your assets minus your liabilities, Alan.
Ooh, that's like almost an accounting term.
Yes. But the problem is the net worth, it's how much income you can derive from your net worth, I think, is more important than what the number is on your net worth.
Right.
I give this example often, is that let's say I had a farm back in Minnesota and it's worth $50 million. I can never sell it and it doesn't produce any income.
Yeah. So what does that get you?
Right. It gets me $50 million net worth.
Right. And living on top ramen.
Right. It means nothing. So, yeah, the net worth is a good starting point just to organize your overall financial life. What do you have in assets? Where are your liabilities at? What are your interest payments? How much money are you saving? Where are your assets located? And so on and so forth. I think it's really good to have a net worth statement. But I agree with Ken here. Don't obsess over it because it really doesn't do any good. It's how are you going to create that net worth to do the things that you wanted to do?
Right. I agree with that. Number 10, have a financial backup person or two.
Huh. Why would you need a backup person? Like when I'm too old,
what if you
miss a RMD?
What you might forget to pay your bills.
Right. Okay. So is that what a backup person
You might
is?
forget to eat your applesauce
Sure.
at lunchtime.
Yeah. Right. Okay. Backup person. I haven't really heard of that term before.
Yeah.
They're not talking about a second opinion?
I'll read the rest. He's very succinct in his writing. It said, whether you, comma, a loved one or a professional, comma, be clear who should oversee your finances if your numero uno choice can't. Numero uno. Maybe that's
number one. That's your number one choice.
I know. But I'm
Spanish.
Bueno. ¿Cómo estás,
Yes.
Señor Joseph Anderson? If you ever need it, that decision made in haste and emotion could be as expensive as any. So let's just say
I don't know, what, like a power of attorney is he talking about?
Yeah. So let's just say you're married. So
Yeah.
your backup person is your spouse, right? But maybe you want another backup person after that, or two.
Is that like a healthcare directive? Power of attorney for financial? Probably. Probably is what I'm guessing.
I would think so.
Yeah.
So like my parents' power of attorney.
Yeah.
Financial. That didn't trust me on health.
Oh, really?
No, well, I don't know. I just saw the financial one. Okay, we finally getting to the end.
Thank you.
Remember, this is philosophical.
Okay.
You'll like this.
All right.
Remember that anger slays.
Well, I'm getting angry.
I get
listening to this.
I got huge peace of mind when a psychologist. So apparently he goes and sees a psychologist. Psychologist buddy. He's trying to say it's just a friend. He's not really going for himself. Taught me to live my actions as if I'd live forever, and my emotions as if I knew I'd be dead in 30 days. So let me explain, because I had to read through it. Every time I anger, I ask myself if I'd waste time over this if I knew I only had 30 days to live. I never do. It's calming. Anger slays investors and you. So if you're going to only live 30 days, what's the point of being angry? News to live by.
I'd be angry that I only have 30 days to live.
Yeah, you'd probably be more angry. So that's our 11 ways to protect your money and sanity as you age.
All right. Well, thank you, Ken Fisher, for that enlightening piece he wrote in. Do we have to give
USA
the source?
Today.
The source, USA Today. Thank
Okay.
you.
Yeah,
You're looking over my shoulder, Andy. Thank you.
We'll put a copy of that somewhere in our show notes.
It is indeed in the show notes for today's episode at yourmoneyyourwealth.com, along with a full transcript of the entire podcast, complete with all the cracking up. As a matter of fact, there is a goldmine of stuff in the show notes for these podcasts. We've got transcripts of our interviews with recent guests like Gene Chatsky, Larry Swedrow, and Jonathan Clements, relevant links to articles, free downloads, videos of Joe and Big Al's email responses, and you can subscribe and listen to the podcast free on demand there as well. It's all at yourmoneyyourwealth.com. Coming soon on the podcast, Dr. Stephen Wendell, the head of behavioral science from Morningstar, is going to tell us ways to ease the retirement crisis. Make sure you don't miss it. Subscribe to the podcast at yourmoneyyourwealth.com. And if you like the show, why not do us a huge favor and share it with your friends?
I wanted to talk baseball and finance. This is a financial show.
Sure.
But I like baseball too.
Okay.
So, a few stats, and this is from NerdWallet. So obviously it's correct. So
Kitches.
yeah, right.
Well, no, that's Nerd's Eye View. Nerd's Wallet. I don't know what the hell Nerd's Wallet is.
Yeah, you're right. They're similar name, but different.
A bunch of nerds.
Yeah. Anyway, if you have you ever thought I'd like to go buy the Dodgers? You ever
No,
had that
I
thought?
haven't.
Or the Red Sox.
That'd be pretty expensive. A couple $1 billion. I would imagine.
Dodgers. The estimate is there were $3 billion.
$3 billion for the Dodgers.
Yeah, 2.8 billion for Red Sox. You get a little discount there.
Huh. I would imagine that the Red Sox would be, well, they're now, they've always been a storied franchise.
Yeah,
but
not
just
a
recently it's been
until,
successful.
Yeah, until recently.
Yes.
Yeah, the Curse of the Bambino.
Yeah.
I think, was it 2004? Was that the year maybe they won the World Series?
Something like that.
First time in like 70 years, whatever.
Yeah.
Okay, so salaries, team salaries. The Dodgers are paying $196 million. The Red Sox $228 million. So Red Sox, but the Red Sox got a better bargain for that. They paid $2.1 million per win, and the Dodgers paid $2.14 million per win.
Wow. They're breaking it down like that, huh?
They are.
Billy Bean.
Yeah, Billy Bean. Red Sox won 108 games. Dodgers 92. Then you look at the highest paid players. Any guess on the Dodgers' highest paid player?
Yeah, it's Kershaw.
That's correct, $35.5 million. And David Price on the Red Sox, $30 million.
Price is kind of a freak.
A freak?
He is.
In what way?
Is that if he gets like nervous.
Yeah. Yeah.
He's awesome. I'm not saying anything bad about him.
Right.
But you can see his adrenaline goes up just a smidge when he's got people on base.
Yeah, I've noticed that. But he's a real person.
He is. Well, I didn't think he was a robot. He plays like one.
So the cost, let's say, what if we wanted to advertise Your Money, Your Wealth nationally? What would the cost of a 30-second commercial?
Oh, I don't know. I don't. We would go on stations and that would cost like 7 cents a minute.
Well, anyway, it's $635,000 per 30-second.
$635,000. If we wanted to do a 30-second commercial of Your Money or Wealth on the World Series.
Yeah.
So what's it? Well, that's cheaper than the Super Bowl.
You're absolutely right. Super Bowl is $5 million plus for 30 seconds.
But really,
according to this,
I suppose there's it could be 7 games in a World Series versus 1 game in the Super Bowl.
Yeah, well, that's true. And this, of course, the World Series. This is Game 7 from last year. We haven't had Game 7 yet, so we don't really quite know. I guess what the cost will be, but let's see a couple more things of interest.
When's Game 3? Friday.
Friday, yeah.
We're taping this Thursday.
Yeah.
Yes.
And people are hearing it Saturday.
Yes.
So it already happened.
And Tuesday.
And Tuesday. Don't worry.
Got it.
Yeah. We got it covered.
We're
By
behind
Tuesday,
the
the
times.
thing's over.
It could be. We'll see. So you want to go to a World Series game?
I have no interest.
Been one of your thoughts?
Not really.
No. You want to know what it costs?
I would much rather watch it like in my home.
Yeah, I sort of agree with you.
You know what I mean?
Unless it's like you're just a diehard fan for that team. I have been to a World Series game, and it was awful because it was the Yankees versus the Padres in 1998, and it was Game 4 where they swept the Padres in 4 games, and I got to watch the Yankees celebrate. I don't think the Padres got like 2 hits all game, something like that.
I don't know. This sounds really bad and snobby, but if I was maybe had a luxury suite or something, I would go.
That is snobby. Sounds like drive up in a limousine. Yeah, I only want a limousine.
I don't want to. I don't like crowds. I don't like big crowds and all that.
I don't want popcorn and hot dogs.
No.
I want chicken,
filet,
Caesar salad. So anyway, the average price of a ticket in 2017 World Series was $1,000 plus.
$1,000.
Yeah, cheapest ticket was for Game 5, which was $828.
It's still not outrageous.
Well, no, compared to the
Super Bowl.
Super Bowl's $3,100.
Yeah. I've heard people like spending like $5,000 on Super Bowl tickets.
Right.
There's no way.
Yeah. Right. So then there's like the winning team. The players get bonuses.
Yes.
For winning. Astros last year they won. They got about $440,000
per player.
Per player. Dodgers lost. They got about 260,000.
Is that average, or did some players get more, or did each player get the equal amount?
It doesn't say, but I'm guessing it's equal.
Equal?
I think that's how they do it.
And did you say they get bonuses for losing as well?
They do. Yeah,
Wow.
just for making it. Yeah. American League, National League. Which league has won more World Series?
American League.
That's correct. 65 World Series compared to 48.
Yeah.
And the winningest team, you probably know, in baseball, World Series.
Well, if it's the American League, New York Yankees.
Well, either league, but you're right. New York Yankees have won 27 times. The next closest is St. Louis, has won 11 times.
Oh.
So that's all I got.
That's it?
Pretty interesting stuff, though, right?
You know what?
Now you can watch the rest of the World Series armed with facts and stats.
Yeah, you know, when you're having a little cocktail party,
I
just
think
say,
you can
hey,
rattle
guess
this out.
what?
Do you know what the Dodgers are worth?
But I wonder, about 2.2 billion.
Yeah,
2.3 billion.
3 billion.
Oh, 3 billion.
Yeah, you weren't listening.
No, I wasn't.
The Red Sox are worth 2.8 billion.
All righty, 2.8. All right, that's it for us. Hopefully you enjoyed the show. We'll see you next time. For Big Al Clopine, I'm Joe Anderson. Show's called Your Money, Your Wealth.
Subscribe to the podcast at yourmoneyyourwealth.com. Find the links in the show notes to subscribe on Google Podcasts, Apple Podcasts, Spotify, Stitcher, Overcast, Player FM, iHeartRadio, TuneIn, and now you can even listen to the Your Money, Your Wealth podcast on YouTube as well. Email your money questions to info@purefinancial.com or call 888-994-6257. Listen next time for more Your Money, Your Wealth, presented by Pure Financial Advisors. For your free financial assessment, visit purefinancial.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. We'll see you next week.